If you wrote a six-figure check to the IRS this year, what if I told you that a single rental property could legally erase a huge portion of that tax bill? Not over 27 years, not spread out over decades. I'm talking about this year. And here's the crazy part. Most high-income professionals, doctors, attorneys, engineers, business owners, have never been shown actually how it works. Meanwhile, real estate investors have been using this strategy for years to dramatically reduce their taxable income while buying appreciating assets. And as of 2026, thanks to the One Big Beautiful Bill Act, which was signed into law July 4th of 2025, that tool is back at full power, 100% permanently. In this video, I'm going to break down exactly how bonus depreciation works in 2026, why the rules just became significantly more powerful, and how investors are using it to keep more of what they earn without aggressive tax shelters or complicated loopholes. I'll show you how the strategy actually works, who qualifies, the biggest mistakes that people make, and a real example that can completely change about how you think about investing and taxes. Make sure to subscribe to our channel because once you understand this concept and many more that I'm about to share with you over the next few weeks, you'll never look at paying taxes or buying real estate the same way again. So let's go. First, let's bust a myth right out of the gate. Most people think that depreciation is just some accounting trick that only really big commercial real estate firms use. That's it. It's complicated, risky, or only for the ultra wealthy. And that's not how this works at all. Depreciation is simply the IRS acknowledging that a building wears out over time. So they let you deduct that wear and tear as an expense on your taxes, even though no money actually left your pocket. It's a paper loss that reduces your taxable income, and that's the foundation of the whole strategy. Now, regular depreciation on a residential property is spread out over 27.5 years, and on a commercial, that's 39 years. And that's fine, but it's really slow. Bonus depreciation is the accelerator. Here's the real mechanism. Instead of waiting 27 years to deduct the full cost of certain components inside the building, bonus depreciation lets you deduct a large portion of all of that in year one. Things like flooring, cabinetry, appliances, landscaping, lighting, and even driveways. These are called personal property and land improvements under IRS rules, and they qualify for 5, 7, or 15-year depreciation schedules instead of the full 27.5. The way you unlock this is through something called a cost segregation study. Think of it as an engineering-based audit of your property. A specialist physically breaks down the building into its individual components, identifies what qualifies for faster depreciation, and hands you a report that you give to your CPA. According to data from the IRS and confirmed by Bigger Pockets, a typical cost segregation study on a residential rental identifies somewhere between 20 and 30% of the property's value as eligible for accelerated depreciation. That's the engine. Now let me show you how to drive it. Here's the process broken into 4 clean steps. Step 1, acquire a qualifying property. Under the One Big Beautiful Bill Act and IRS Notice 2026-11, any qualified property acquired after January 19th, 2025 is eligible for 100% bonus depreciation. That's permanent now. No phase out, no expiration date. The property can be actually used or new. It just needs to be new to you. Step 2, commission is a cost segregation study. This is critical. Without it, step 3 doesn't work. You have to hire a qualified firm. Studies typically range from $500 on the low end to $5,000 or more for larger commercial properties. And according to White Coat Investor, the study reclassifies eligible components into shorter depreciation schedules. Step 3, apply 100% bonus depreciation to the reclassified components. Here's where the math gets real. Let's say you purchase a $500,000 short-term rental property. Your cost seg study identifies $125,000 in components eligible for this accelerated depreciation. That's roughly 25% of the property's value, which is consistent with what Bigger Pockets investors are reporting in 2026. Now, with 100% bonus depreciation, you deduct that entire $125,000 in year one. If you're 37% federal tax bracket, that's approximately $46,000 in real tax savings in a single year. On a $200,000 property at 32%, that's about $13,000 in year one savings. Step 4, make sure you actually use a deduction. This is where most people get tripped up. Depreciation losses are typically considered passive, which means they can't They can only offset passive income and not your W-2 salary or your 1099. There's two ways around it. Number one is real estate professional status, REPS, which we covered in another video, but that requires 750 hours per year of you and specific actions and activities. And the other one is the short-term rental loophole, which we also covered in a separate property. Those are the ways that these losses are considered non-passive. Both these strategies are legitimate, but you have to have a CPA prior to purchasing any of these properties who has a lot of real estate background. Now, let me address the questions I know you're already asking. What about depreciation recapture? Don't I have to pay it back when I sell the property? Yes and no. When you sell, the IRS does recapture depreciation, but here's the key. It's recaptured, number one, at a maximum rate of 25%, not your ordinary income rate. So if you took a deduction at 37%, you're still coming out ahead. And if you use a 1031 exchange to roll that into the next property, you defer recapture entirely. As White Coat Investor puts it, buy, depreciate, exchange, and repeat. Done right, recapture may never come due in your lifetime. What if I bought my property before January 19, 2025? Then the old phase rules that did exist, they still apply. So properties that were put into service before that, they were limited to 20% bonus depreciation under the IRS rules. That's still meaningful, but it's not the same as 100%. The full benefit is for properties acquired after that date, January 19th, 2025. Isn't this too aggressive? Could it trigger an audit? Cost seg is a fully IRS recognized strategy. It's not a gray area, and it's fully supported in their tax code. Now, there was a notice published this year in January. The key is doing it correctly with a qualified professional and accurate documentation. Imagine this. 5 years from now, you own 3 or 4 cash flowing rental properties. Each year, your cost seg study generates tens of thousands of dollars in paper losses. Those losses offset the income you're earning in your career. You're building equity, you're building cash flow, and your tax bill is a fraction of what it used to be, legally, permanently, and without stress. That's not a far-fetched fantasy. That's literally what thousands of investors are already doing in 2026 with this same exact strategy. So if you're serious about building that kind of long-term passive income without becoming a full-time landlord, without taking reckless risk, and without spending years figuring it out on your own, then the next step is that you can head over to cardia, REI.com. There you can download 2 free ebooks and access a free 9-part passive investing masterclass that is free. I created it, and it's the things that I wish I had on day one. This is what many conservative long-term investors use to slowly build passive income through real estate, step by step, in plain language. It's completely free. It's built specifically for busy professionals who want real results without all the guesswork. And if you're ready to stop overpaying the IRS and actually start building real wealth, then go ahead and grab those resources right now. The best time to start was yesterday, but the second best time is today.